everybody, welcome back to Anjana's Stockpedia. In this video, we are going to discuss about what is breakout and how to trade in breakouts. Before that, if you are watching my channel for the first time, please subscribe the channel and press the bell icon for the further notification of new videos. So, let's begin the video. First, let us discuss what is a breakout. A breakout occurs when the price breaks out and closes above a resistance level or below a support level. Let's quickly look at a candlestick chart to illustrate what support and resistance levels are. A support line can be identified by connecting the two low points of instrument's price. They are identified as low points if the price rebounded upwards right after reaching the points. Definition of the support line needs at least 2 points to be formed, but I suggest finding 3 points for a stronger indicator. The support line can be horizontal or angled. Resistance lines are effectively the same as support lines, within the marked difference that they are above the current price and act as a ceiling from which the price falls. From again, they can be horizontal or angled. When we have a support and resistance lines together, they create a trading range. So both lines keep the movement of the price within a certain range until the price makes a break either above or below trading range. Trading ranges are formed due to supply and demand and market psychology. When the price breaks out of the range, it signals a change in the supply and demand and the beginning of an uptrend or downtrend. Let's say the price breaks out above the resistance level. At this moment, the resistance line might become a new support level and the supply and demand has shifted. So, most likely new levels of support and resistance will be established. So, here's the general concept to trading breakouts. You can use the breakout strategy to trade forex, stocks or commodities, and it works with any time frame. It's a method of technical analysis that follows certain rules and can be applied universally. So what first? First you need to find a financial instrument, stocks, pair of commodity with a clearly defined support or resistance level. We only need one clearly defined support or resistance level to anticipate breakout. However, a trading range created by both the support and resistance level is more beneficial, as you can take advantage of the breakout in either direction. So either above or below the current range. That said, how should you enter your order in a breakout? We assume that the breakout should be above the current range. So there are several ways to enter the market at a breakout or depending on your trading style and risk tolerance. The first is at the actual breakout to trade. At the breakout, you would need to devote more time to actually watching the market, so that you can place a market order whenever the breakout occurs. This is the most risky entry point, as the movement has not been confirmed and there is a high chance that price will move back into the trading range. The second entry type is a pending order at a price level placed above the current range. This is a preset price level that can be based on the current range or determined by an indicator. We recommend that the price level of the pending order is that a previously unattributed automatically upon reaching the price. The third entry is to be wait for the candle on the to time frame you have selected to close above the range, reaching a new high, and in this way confirm the breakout. We suggest that you exercise patience in order to confirm the breakout. Having the candle close above the range is one of the strongest possible signals for a continued upward movement. Once you have determined your entry, you will need to have your exit strategy in a place in a good way to determine a reasonable target to analyze the previous price movements of the financial instrument. Your exit strategy will largely depend on the specific trading circumstances, trading style, your expectations, and the risk to reward ratio you are using. The balance you have to consider when placing your stops to exit your trade is to set them not too far so that you don't lose too much money if the market turns against you, and not too close so that small price fluctuations take you out of your trade too early. In this case, we could decide to place it right about here, which would be at our maximum permissible loss. One thing to look out for when trading breakout is fake breakouts. Fake breakouts occurs when the price breaks past the support or resistance level. But trading range, so here we can see that the price breaks outside of the range but does not close above. It returns back into the trading range and does not continue its movement upwards. So if you had placed your entry here, you would in fact have been caught in a fake breakout in order to decrease your chance of trading. A fake breakout, we suggest you wait to see if the price will continue to move in the intended direction. For insane, it's good to wait for a new high. Before going long in this way, you will sacrifice some of the momentum of the trend, but you will ensure it's going in the direction you anticipate.